Hello, everyone, and welcome to session 10 of Financial Statement Analysis series by Finacle Shah Classes. I'm Shailesh, and I will be continuing our discussion around analysis of various sources of revenue from our previous session 9 discussion. Now, in our session 9 discussion, we talked about how to analyze standalone revenues, consolidated revenues, how to understand different revenue activities of entities within the umbrella of consolidation, which a company is doing. Now, while doing so, we also studied how to study or how to read related party transactions and use those data points to, picture how the business is functioning across different entities, which fall not just in the umbrella of the consolidation, but also promoter related entities. Now, the discussion we ended was on a very curious note where we talked about usually one would anticipate that standalone revenue figures would be less than the consolidated revenue figures. However, that need not always be the case. There can exactly be an opposite case as well, where consolidated revenue figures may be less than the standalone revenue figures, owing to the magic because of related party transactions. Let's in fact take a live case study at point in this reading 10 around the same. So the case study at point here we have is Prabhat Dairy. Now, Prabhat Dairy is into procuring milk, creating dairy products, and eventually selling those products outside. Now, if I were to actually refer to the right numbers, I have a quarterly financial statement announcement here, because in quite a lot of quarterly figures, Prabhat Dairy had lesser revenues in consolidated as compared to revenues of standalone figures. Let me actually show them to you so that you can take a look. Now, the figures which you have in front of you are standalone figures for Prabhat Dairy. Let me actually write down these figures so that we can have it for reference and comparison purposes. So the revenue from operations which we see for the standalone figures, remember, the quarterly figures are often unaudited, and this is as of quarter 1 2019, because 30th June period is quarter 1 2019. So the revenue figure which you see for quarter 1 2019 is roughly 433 crores for standalone. Now, how did I decipher that? Obviously, we see the figures to be in lakhs, so these would be 43 crores. Now, let me actually scroll down a bit to the consolidated figures for everyone's reference. When we scroll down to the consolidated figures, we'll see, okay, yeah, these are the consolidated figures. When we take a look at the consolidated figures, once again, for the same quarter period ending of, quarter 1 2019, revenue from operations is 385 crores. And remember, this is consolidated. So the standalone revenue figure were 433 crores and consolidated revenue figures are 385 crores. Now, for a person who doesn't really understand the concept of related party transaction, would feel that maybe the subsidiaries have negative revenue. Now, that's absurd. That's, rarely a case, something which we have seen where the revenues are negative, returns are more than the sales made. So precisely why, the question moves in the direction of related party transactions, whether maybe what could be happening here. Let's take a look using a simple dummy numbers example. Now, what happens is Prabhat Dairy often procures milk, sells that milk to its subsidiaries. The name of the subsidiary is Sunfresh Agro, and Sunfresh Agro processes that milk, produces a couple of products, sells those products to Prabhat Dairy, and then Prabhat Dairy sells it outside. So for the viewer's perspective, let me actually pen it down. So Prabhat Dairy, which is the standalone entity, basically sells milk to Sunfresh. Now, Sunfresh is a subsidiary of Prabhat Dairy, which eventually sells back processed products. Let's just call it paneer. Sells processed products to Prabhat Dairy, which eventually Prabhat Dairy sells outside. So now, if you were to actually open the annual report of Prabhat Dairy, you will see that there are purchases as well as sales to the subsidiaries. Remember, not all related party transactions are with subsidiaries, but in this case, precisely what's happening with Prabhat Dairy is this. Now, you will see huge purchases as well as sale transactions with the subsidiary. that plays the magic here. Let me take a dummy numerical figure illustration so that you understand how this is happening. Now let's take a look. So let's assume that Prabhat Dairy sells 100 rupees worth milk to Sunfresh. Now, naturally, Prabhat Dairy is earning a revenue. And let's say that procurement of that milk cost Prabhat Dairy 90 rupees. So COGS for Prabhat Dairy is going to be 90. Now, I'm referring to standalone figures here. And for Sunfresh, because Sunfresh is actually buying that milk, it's become COGS. And when Sunfresh actually processes that milk into, let's say, paneer, and eventually sells that paneer at 140 rupees to, let's say, Prabhat Dairy. So the Sunfresh receives a revenue of 140 from its standalone parent company, which eventually becomes a COGS for your standalone parent company. I hope everyone is actually able to paint a good picture here. At the same time, now, Prabhat Dairy actually sells this paneer, or rather resells this paneer after buying it from its own subsidiary outside at 160 rupees. So that 140 rupees, which is recorded as COGS, will see a revenue boost of 160 rupees. So let's calculate the total standalone revenue of Prabhat Dairy would be 100 rupees earned from milk for standalone, right? So 100 rupees earned from milk and 160 earned from paneer. So in total, you will see 260, which is where you will see the working here, 100 plus 60, 160. Now, in terms of COGS for Prabhat Dairy, once again, it required procurement of milk cost, which was 90, and then it bought paneer at 140 rupees from its subsidiary. So 90 plus 140, it will have a COGS of 230, giving a PAT of, or let's say for now, just in a simple fashion, a profit of 30 bucks for Prabhat Dairy. Now, in terms of Sunfresh, Sunfresh actually made a sale of paneer, and it was done at 140 rupees. So it is going to see a revenue figure of 140. And COGS would be, first of all, it procured milk from Prabhat at 100 rupees, and then eventually, sold it in as paneer. So that becomes a COGS of 100 rupees. Profit will be 40. Now, let's actually create a consolidated entity here. Now, for consolidated entity, as a company altogether, the only product which was sold outside was paneer, and it was sold by Prabhat Dairy at 160 rupees. So the revenue is going to be 160. So you add both the revenue figures of standalone and subsidiaries, and you subtract the interrelated party transactions, which were worth 100 and 140. So which is where 260 plus 140 minus 100 and minus 140. This was milk and this was paneer. So precisely, if you subtract it out, you get a revenue worth 160 made to the customers outside Prabhat Dairy. When you take a look at COGS, naturally, one party selling it to the another party, those COGS are also going to get cancelled out. So if you add these two COGS, 230 and 100, the 100 rupees milk which was sold was procured at 90 rupees. And likewise, so eventually for the overall consolidated entity, the only outgo for that entity was 90 rupees. So COGS is 90, and the revenue figures 100 and 140 will get backed out. Precisely how, the interrelated party transactions are usually cancelled out, which is where an interesting scenario comes across to the picture, that the standalone revenue is 260, which is definitely more than the consolidated revenue figures. And if you compare the profit figures, profit figure of standalone is less than the profit figure of consolidated. Now, precisely a very interesting live case study which happened with Prabhat Dairy. Now, you may be thinking that, this need not happen with all the businesses, right, which engage into related party transactions. Absolutely right. Not every company which engages into buying and selling with subsidiary will be seeing its standalone revenue to be, more as compared to consolidated, because first of all, there are quite a lot of assumptions here. When we took this example, the perspective was only to educate the viewers of this video how interrelated party transactions are working its magic. However, it's a lot more complicated in real life, because there are leftover inventory when a parent is actually making a sale to subsidiary. That's basically called a downstream transaction, something which we referred to in our previous reading of lecture 9. Moreover, let's say if Sunfresh is selling it back to Prabhat Dairy, that's an upstream transaction. Now, in the downstream and upstream transactions, it's always possible that the inventory spillovers or leftovers are present in individual entities, which is why the revenue figures are not that easily computed just by adding the top lines and subtracting the related party transactions. But in fact, a proportion of what is the ownership of that, it comes into picture. But we, like I said, we don't want to get into too much complicated nuances there, but the broad level logic should be very clear to the viewer. Is precisely what we want to communicate here. More, which is why not every transactions or every company which engages into related party transaction with its subsidiaries will not see their standalone revenue to be more than the consolidated revenue. Precisely, this is happening because the numbers are playing that magic, as well as the theory behind the numbers is something like this. Another thing which we want to communicate is, another very big assumption here was Sunfresh was selling all the paneer to Prabhat, which honestly speaking is not really the case in Prabhat Dairy, because Sunfresh also sells across paneer to Prabhat, as well as it also sells across paneer to outside entities. Now, if the selling figures of paneer outside entities are far much more as compared to the paneer which is sold to Prabhat, in that case, the signs may change and the consolidated figures may also change. So depending on that quantum, the consolidated figures may be different, which is why concluding the fact that not all related party transactions would imply, let's say if there is upstream and downstream transactions simultaneously, it doesn't necessarily mean that the standalone revenue is definitely going to be more than the consolidated. It only happens in the case where subsidiary is selling everything to you and you eventually selling it outside. So only precisely in that case, something like that may happen. Now, in case of VIP, which we studied in lecture 9, VIP Industries India, the parent company, wasn't selling anything to the Bangladesh subsidiaries. There was only upstream transaction from Bangladesh subsidiaries to VIP India. So there was only upstream transaction which was playing magic there. But in case of Prabhat Dairy, it's both upstream as well as downstream. So hopefully that clears the picture for you guys. Moreover, you might ask, how did you confirm your understanding? Precisely what an analyst should always do is, even if let's say numbers are playing that magic, you take a look at the footnote, you should always try to corroborate it with some or the other primary source. When we took a look at the con call earnings, in fact, one brilliant analyst out there in the industry, Rahul Ranade, he basically asked this question. Why is it that you have a standalone revenue higher than the consolidated revenue? Remember, see how people track these things on a micro level. So, kudos to the analyst who observed this and obviously highlighted it out in the con call discussions. But which is why, we added this as a very important checkpoint, that everyone should analyze revenue based on the sources, and one of those angles being standalone and consolidated figures. Because, when we actually made that leap of faith, as well as, we applied that concept to VIP Industries, we actually were able to make brilliant conclusions and figure out how the business is actually working. Now, the same logic was confirmed by, the CFO of the business, I believe. Yeah, sorry, he's not CFO, he's CEO, I think. The CEO of the business confirmed the same logic. It was basically because of internal kind of stocking, because, they tend to, here it is, Prabhat Dairy and Sunfresh, whereas the milk which is procured in Prabhat, it helps Sunfresh, and then eventually Sunfresh sells those packaged back products to Prabhat Dairy, and Prabhat Dairy eventually sells it outside. The same thing which we explained through dummy numbers. Now, studying related party transactions is extremely, extremely important footnote, as we discussed in previous reading. I again want to stress a lot on this, because a lot of people tend to ignore this footnote in their analysis, which is completely wrong, because the reason why accounting standards have mandated this footnote is for the owners of the company, basically the equity providers of the company, to be able to figure out if there are any potential conflict of interest between the management who's running the company and the owners who are basically financing those operations. Now, the thing is, these related party transactions are always disclosed, not just for subsidiaries, associates, or joint ventures, but in fact, these related party transactions are defined as transactions between two companies where the promoters of the company or the management of the company has deemed interest with some other company where shareholders may not be involved, or maybe it is a private company, and leading to a conflict of interest. Now, you may be thinking, how is it that there will be a conflict of interest? In fact, we have seen quite a lot of promoters who have portrayed dirty intentions and siphoned off money from a publicly listed company to the privately owned company completely by them. To give you a bit of a perspective, now imagine there is a listed company, obviously taking a dummy example here, assume that the promoter has ill intent towards the shareholder. So if the company, the listed company, is selling a particular product to a private company, which is completely owned by the management of this listed company, or let's say the wife of the management of this listed company, They are selling this product at a very cheap cost to the private company, which eventually sells across at an exorbitant, or rather the fair market value of the price, market value of the finished product. So what's happening is, through this transactions, management of the company ensured that their private companies buy these finished goods at a very cheap cost from listed companies, and eventually kept all the profits by selling it at fair value in the markets to themselves, and depriving the owners of the listed companies to get that profit. Because if this listed company were to sell that product outside, they would have perhaps sold it at a very higher price. Let's take dummy numbers. Let's say you're selling this particular product at 60 rupees to the private company, which eventually sells it outside for 100 rupees. The 40 rupees profit, which the private company owner is keeping to himself, that entire 40 rupees, 100% will be attributable to the management of the firm, promoter of the firm. Had this listed company sold that product outside, they would have been able to sell it at 100 rupees. That 40 rupees profit, or the incremental 40 rupees profit, would have been split across the owners of the firm. So what happens is, management sees that he's getting a larger share of the pie by selling it to the private company, which eventually sells it at a very higher price, or the actual market price out there. What happens is, we have seen such cases out there in the past where promoters have these kind of dirty intentions because they want a higher share of the pie without actually having to pay for it. So in such cases, they often engage into these related party transactions. Another example would be, let's say, a listed company basically buys raw material from a particular company, and so raw material they are buying from a particular company XYZ, and this company is 100% owned by the management of this company, or let's say wife of the management of the company, or something like that. Now, what happens is, let's say if they are buying raw materials at 90 rupees, which by the way would be available at 60 rupees out there in the market, when they sell the products outside, they would have earned, let's say, at 100 rupees, because they are actually buying these raw materials from this XYZ company. The shareholders of this listed company are losing out on a profit of 30 rupees, which is completely made, or rather goes into the pockets of management of the listed company, who is secretly, or rather privately, owning this company 100%. Now, by selling the raw materials, which ideally should have been sold at 60 rupees, by selling it at 90 rupees to the listed company at exorbitantly high prices, they are essentially robbing the shareholders of their wealth. So these kind of dirty tricks have been played in the past. Now, please don't get me wrong. Not every promoter who engages into related party transactions may be playing a dirty game. Please do not have that mindset. I've talked about this in our lecture 9, where I explained, when financial statement answers, there is no such thing as black or white. Everything is gray. So we have to figure out, the materiality of the transactions. At the same time, if the transactions are fair. Now, one may actually question the fact that, while auditing, why didn't the auditor verify these things? We have often seen even auditors, the promoters skip the ropes there, and auditors not being able to catch these kind of things, or maybe turn a blind eye towards such cases. So, keep these things in mind. In fact, we are going to cover one such very interesting case study in our next blog, 111, or the lecture 11 of the financial statement answer series. With this, stay tuned for the next one, because it's going to be a crazy one and a very interesting case study. In case if you have any questions around this particular discussion or reading, please do mention it in the comment section of the video. You can also refer to the written blog on our forum section, financial statement analysis. You can also mention the questions and comments here. You can subscribe to more such educative content through our Instagram handle, finacle_Shah. Request you to like the video in case if you like the content, and subscribe to our YouTube channel for more such educative content. Thank you so much. I look forward to seeing you guys in the next session.